Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Let's dive deeper into their pros, cons, and how to choose the right ones for your portfolio. Strategies for investing in sector-specific ETFs. Sector-specific ETFs aren't just about buying and holding. Savvy investors use them for tactical moves, hedging risks, and capitalizing on shifts in the economy. Whether you're reacting to market trends or planning long-term, these funds offer precision without the complexity of individual stocks. Tactical asset allocation with sector ETFs. Market conditions change, and so should your portfolio. Sector ETFs let you adjust exposures quickly based on macroeconomic signals or sector momentum. Here's how to use them tactically. Follow the money. When certain sectors outperform, shift allocations to ride the wave. For example, rising interest rates often help financials, XLF, while tech, XLOC, may lag. Economic cycles matter. In early recoveries, cyclicals like consumer discretionary, XLY, and industrials, XLI, tend to lead. Defensive sectors like utilities, XLU, shine in downturns. News-driven opportunities. Policy changes, like green energy incentives, can boost sectors overnight. ICLN, Clean Energy ETF, surged after U.S. climate bills passed. Rebalance quarterly or semi-annually to stay aligned with trends. Don't overthink it. Let the market's momentum guide your moves. Hedging and risk management. Sector ETFs can protect your portfolio when markets get shaky. Here's how. Pair trades. Offset weak sectors with strong ones. If tech stocks slump, healthcare, XLV, or consumer staples, XLP, often hold steady. Short-term defensive shifts. Before earnings season or Fed meetings, rotate into less volatile sectors like utilities, XLU, to reduce downside risk. Inflation shields. Energy, XLE, and materials, XLB, ETFs often outpace inflation, making them useful hedges. Think of these ETFs as shock absorbers. They won't eliminate losses, but they can soften the blow when broader markets dip. Sector ETFs give you control. Use them to adapt, defend, or strike when opportunities arise. Risks and considerations of sector-specific ETFs. Sector-specific ETFs offer precision, but they come with unique risks. Unlike broad market funds, they're tied to the fortunes of a single industry. That means higher rewards and higher stakes. Before diving in, it's worth weighing the pitfalls. Volatility and sector concentration. Some sectors swing harder than others. Tech, XLK, and biotech, IBB, for example, are known for sharp ups and downs. When these sectors rally, they can supercharge returns. When they crash, they drag the ETF with them. Key risks to watch. Concentration danger. Heavy reliance on a few top holdings, like Amazon and XLY, means one bad earnings report can tank the ETF. Sector shocks. Regulatory changes, supply disruptions, or innovations can reshape entire industries overnight. The 2022 chip shortage battered semiconductor ETFs, SOXX. Liquidity gaps. Lesser-known sector ETFs may have wide bid-ask spreads, costing you extra on trades. Imagine betting on retail, XRT, just before a recession. Consumer spending drops, and so does your ETF. Sector concentration amplifies both wins and losses. Timing and economic cycles. Economic shifts hit sectors unevenly. Consumer staples, XLP, thrive in downturns, while industrials, XLI, need growth cycles to shine. Buying a sector ETF without considering the economic backdrop is like wearing flip-flops in a snowstorm, misplaced confidence. Here's how cycles play out. Expansion phases. Cyclical sectors, financials, discretionary, lead. XLY often outperforms as spending rises. Recessions. Defensive sectors, utilities, healthcare, stabilize. XLV typically holds up better than the broader market. Interest rate changes. Banks, XLF, benefit from higher rates, while tech, XLOC, often stumbles. Miss the timing, and you could be stuck holding a lagging sector for years. For example, energy ETFs, XL, boomed in 2022 but flatlined when oil prices cooled. The lesson? Sector ETFs demand vigilance. They're powerful tools, but only if you respect their risks. Final thoughts. Sector-specific ETFs like XLV and XLY give you a straightforward way to invest in industries you believe in, without the hassle of picking individual stocks. They offer targeted exposure, lower costs, and flexibility, making them useful for both short-term trades and long-term strategies. The key is balance. These ETFs work best as part of a diversified portfolio, not as a standalone bet. Pair them with broad market funds to spread risk while capitalizing on sector trends. Watch economic cycles, stay mindful of concentration risks, and adjust as needed. If you're curious, start small. Research how different sectors perform under various conditions or talk to a financial advisor to see if they fit your goals. The right sector ETF could sharpen your portfolio. Just use it wisely. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.